Let's bring in Kevin Green now, our senior markets correspondent, to help us get across some of the flash PMIs that we got this morning. So I've just seen the numbers, Kevin. We've got a 52 reading on the manufacturing, the composite coming in at 53.6, services 53.9. So all above the boom or bust line pretty comfortably, but it was actually weaker than expected and coming off from the previous month. So what does that tell you?
Yeah, you are seeing a little bit of a deceleration here. Actually, if you're kind of looking at the S&P 500 global, or the S&P global PMI data set here, a lot of this is actually inventory buildup that's providing a little bit of pressure to the downside. But you do have actually a bright spot. You are seeing prices or input prices actually decelerating, and that's actually a leading indicator to consumer prices also moving to the downside. So that's actually a benefit. As you kind of talked about, you're seeing an expansion number. Anything over 50 is expansion pretty much across the board, but coming in a little bit light. But I think the prices component is probably a bigger factor here than probably the overall sentiment when it comes to services as well as manufacturing. Manufacturing continues to be fairly weak, but services itself is still holding up for the most part here. Not a big mover when you're kind of looking at this, Sam. The S&P global numbers are not as impactful as the ISM manufacturing, but they do kind of trend in the same type of direction. So this might be a nice little forward indicator as to what we could see over the next week or so when it comes to ISM services as well as ISM manufacturing. And that, if it's going in this type of trend, probably is going to be a benefit for the equity markets as a whole.
Yeah, no doubt a sentiment-based survey, but certainly important to keep tabs on very much how businesses are feeling right now. Speaking of that, tell us what you're seeing out of the Richmond Fed this morning as well.
Well, those numbers have been a little bit delayed. So if you're kind of looking at the trend that we've seen from these regional Fed surveys, we've actually seen an improvement over the last couple of months, especially when it comes to the pricing component as well as new orders. And for the Richmond Fed, I don't have that data set as of right now. My screen has not been able to update that at the moment here. But I would actually expect that we probably will see the same type of trend moving forward. Hopefully the prices component continues to remain, tries to decelerate here, trying to take a little bit of the edge off of the Fed when it comes to the inflation metrics just in general. So once again, I don't have the numbers on my screen. Maybe you already have the numbers being printed out on yours, but the trend has definitely been rebounding over these several regions like the New York Fed and things of that nature, Empire State.
Okay, but as far as overall PMIs, as far as what we've got this morning from the flash PMIs, I mean, certainly, as you point out, a bit of a deceleration there, perhaps building the case for what some of these Fed speakers have been talking about, particularly Bowman out this morning as well. But we also got some information out of Europe overnight. The Eurozone PMI very much being held up by the strength we're seeing in the services component out of Germany. I believe that was a 16-month high, which stood in stark contrast to what we're seeing out of France. Obviously, they've got a few political uncertainties going on there as well. But what does this tell you? Because I've also seen the OECD expecting global growth to accelerate as well. Once again, looking at 3.2% versus 2.9% now. I'm just wondering, how you join the dots now, Kevin.
Yeah, I mean, it's definitely imbalanced here if you're looking at the Eurozone just in general. As you talked about the strength with Germany, you're seeing a massive amount of acceleration over the last couple of months when it comes to the overall composite. As you talked about, that's been up to 52.4, which was actually being reported a lot higher than the street's expectations, and it's the fastest growth that we've seen over 16 months. But France is actually still seeing some headwinds. Obviously, there's some political turmoil that's taking place there as well, and they are seeing a little bit of a deceleration across the Eurozone as a whole when it comes to new orders, which is also putting a little bit of pressure on the manufacturing sector as well as the services sector. But for the most part, we have seen the ECB actually holding rates at this point in time. They want to kind of see the data actually kind of develop over the next couple of months when it comes to inflation as well as economic growth. And you still have some issues in some pockets of a rising inflation or inflationary pressure. So overall, I think when you're looking at the Eurozone PMI data that we had, mixed. But Germany is the biggest component of the Eurozone, so as long as that's showing a little bit of strength here, it might buoy the rest of the Eurozone economy.
Okay, and just sticking with the international theme and very much a lot of these trade negotiations that we continue to track as far as hammering out some of the details of these deals. One thing I know you've highlighted is actually how they're talking about the commercial feasibility right now of what the South Koreans will actually be able to commit to on their end of the deal with respect to trade with the US, now that Trump is managing to secure huge commitments from the likes of the Japanese, also Europe. So what are you seeing there as far as just how much the South Koreans can commit to right now and some of the big concerns there at the moment, Kevin?
Yeah, this one's actually a very interesting development. So there are obviously trade negotiations going on between the U.S. and the South Koreans. It appears the South Koreans, the U.S. is demanding around $350 billion worth of payments to be delivered to the United States. And the president of South Korea yesterday kind of mentioned that if they were to take that action, you could actually see foreign exchange and currency issues and create potentially a financial crisis in-house. And so the solution that they are actually looking at is opening up a swap line with the Federal Reserve, the U.S. Federal Reserve, which basically just means that they would put up their own currency. The Fed would then fund the U.S. government with the dollars that are looking to be deposited, $350 billion or so. And then there's like kind of a little bit of a line of credit, which makes it a little bit odd because it then would be, the Fed actually financing some of these trade deals rather than the country itself. But that may be needed in order to not create any type of disruption when it comes to the foreign exchange, especially in the Asia-Pacific market. So a very interesting development to see if this actually does play out here, but just kind of shows the pressure the U.S. is putting on some other countries in order to try to bring some assets here domestically.
Yeah, and I suppose still the big question that remains is that, while they have certainly committed to some of these hundreds of billions of dollars worth of FDI, it's really all about whether they actually follow up on that and some of the implementation as well. But such an important story to highlight. Thank you so much for getting us across that one, Kevin, and also breaking down the PMIs.